Hey there, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. Yeah, so some exciting stuff going on. We see Ryan Cohen filing this 13D, moving his shares over from RC Ventures over to his personal account. Some big implications there, potentially if there is some question about whether these shares have been loaned. What it's going to mean moving from the DTCC over to the CDS, Canadian Depository Service, or something like that, right? What is it going to mean moving these shares over international boundaries? We're not sure. It might have an effect on the price, but right, obviously, whenever these events come through, it's very important at this point. I always remind myself of this, right? This situation that GameStop finds itself in is one where institutions are heavily on guard for these types of news events, and they are certainly quick to exploit these in a way that keeps the price rate, makes it look perhaps to the inexperienced eye that these types of movements are like out of control or something like that, like things we saw back in 2020 and 2021, when in fact, right, a lot of these movements do end up being fully within the parameters of what institutions are comfortable allowing. And as we've seen many times, they've even been able to direct these in ways that they've been able to profit off of. So certainly I'm reminding myself of that potential. But let's certainly take a look at today, right? What factors, what are we looking at structurally in our options landscape, in our broader market context, in our technicals, that might give us some inclinations as to what we would expect, right, outside of maybe speculation on some of these external factors, right? Because, of course, with what this might mean with respect to the 13D, right, yeah, of course, you see lots of people out there speculating, oh, the 13D means this, oh, it means this, oh, it's going across the border, oh, it's a tax thing in response to Trump's executive order. It can mean a lot of things. I certainly don't know what those things are. So here, right, as we do every day, we're going to look at the things that we can get some insight into, and then, kind of put a box there, right? Kind of allow in the back of our minds, like, okay, we have our daily model. Oh, okay, maybe we got this thing going on in the background with Ryan Cohen's 13D. Let's kind of make sure that that's on the horizon. But where exactly does that go in our probability model? Who knows, right? Where does that go in our forecast? Where does that go in our price action model? Hard to say because we don't have data on that. At least I don't have data down that avenue. So we're gonna take a look at our usual factors today. A lot of continuities, but that's going to be our focus. Right, headline for today: 2650 short put floor strengthens. Yeah, we're gonna hop into this. I'm gonna unpack this kind of 2650 short put element and what that has to do with market maker hedging today. Right, this has been a common theme, actually, interestingly. Over the past couple weeks, this sort of inflow of a high concentration of trader short puts. So we're going to think about that a little bit today. Of course, once again, today, thanks to Goat Zuback for sponsoring today's newsletter and today's video breakdown. Thank you very much, Goat. You are the GOAT. Yeah, certainly appreciated today's coffee. So thank you very much. Thank you for your support. And as always, of course, thank you to Dat Scruffdo. Scruffy, thank you so much. Blessings, peace to you and your family. Always appreciate your support here on a regular basis. You guys, and of course, everyone else who has supported me in the past or who has shout outs coming up, who has been able to buy me a coffee. Thank you so much. You guys help me keep all of this completely free, completely open access, right? I'm not monetized on YouTube, not monetized on Twitter. Was never monetized on Reddit. So you guys, thank you so much for helping me continue to continue my work and my research here and help keep our fellow investors, I should say, informed with respect to GameStop. So big thanks there. Yeah, all right. We have some Ryan Cohen, of course, filing this 13D. Could it potentially lead to a share recall? Was this something maybe that Roaring Kitty was hinting at with his bring it to me with Unity? Is it like, oh, hey, let's both recall our shares together or something like that, right? Could be something like that. Could be something like that. But as I said, right, at this point with these types of catalysts, this is speculation. There's no way certainly for me to be able to figure out what they will do beyond just kind of saying, oh, what could they do? Something like that. They've both Cohen and Keith Gill have prided themselves. Well, I don't know about prided themselves, but they've made a point to try to stay unpredictable in many cases throughout this saga. So, right, that goes against, say, the things that we see institutions and traders do. They look for things that are repeatable, right? They're trying to farm profit out of the market with repeatable strategies and cycles. So it's different, right? Roaring Kitty and Ryan Cohen are not cyclical players. They do not do things on cycles. They try to anticipate. Yeah, they try to anticipate actually, right, how these patterns replay over and over and over again, and then develop strategies either for their own trading or their own investment or for the health of the company that actually take advantage of these repeatable patterns, right? I think that's something certainly that Roaring Kitty, Keith Gill, was hinting at with his Dune, that kind of sandwalk thumper thing there, right? So part of the reason in Dune is that say Paul Atreides or the Fremen in Dune are able to ride these massive sandworms is that they follow this very predictable rhythmic pattern, which they end up being attracted to this with the playing of the thumper. And so they're able to, the Fremen are able to predict when these worms will show up, and then they can just hop on top of them and ride them. So something like that, right? So I won't go too heavily into speculation here. But yeah, let's talk about our current context. We sure did get that, right? So yesterday I said, wow, SPY, we're kind of sitting right there on this gamma flip line, like right, if we go up, we're going into positive gamma territory, and then we're going to probably move towards our call walls and overhead target. We go below this, we run into a couple volatility thresholds, especially around 600. But really, we don't get into kind of critical down territory until we cross that 590 level. So what did we do yesterday? Man, we just hung out there right on top of that line all day. We basically scrub a dub right on top of that, right around 603, right? Slightly below, slightly above. Didn't move too much until it was time for the Fed meeting. And then some volatility, shoot down, and we stopped right at 599. Why did we stop at 599? Well, it turns out, right, just as we have kind of these gamma ramps that we've seen, right, especially in GameStop, they tend to go to the upside. But right, why did we see that there? Well, we have a hedging dead zone. Okay, 599, we ramp up a bit. 598, we ramp up a bit. Is that right? No, 599. 599 ramps up a bit. 600 got this big position. No, it's 598, I guess. But right, just below this, stuff kind of cools off here at 599. Pretty neutral strike. 598 ramps up. Then we got another gap here before we get into some more volatility. So, okay, we moved down. We kind of ramped up into the 600 position. But then on the other side of that, up, neutral, really no market maker hedging pushing us in one direction or the other. So we stalled there. And then, of course, everything was as expected. With the Fed meeting, there wasn't anything particularly big, right? You can see here. Right now, this is today's data. We still have this kind of neutral zone from 597.50 up to 599. Neutral, very neutral. Little 598, right? Still kicks up a little bit, but it's pretty neutral. We're not talking big volatility. We're not talking 595. We're not talking 600. We're certainly not talking 590, which is the highest out of any of these, right? We can see here these areas. So what are we looking at today? I mean, maybe we get a little test of this again, but right now, in terms of pre-market trading, we are up right in this positive gamma area. And I don't know, right? I don't know necessarily how to anticipate what we're looking at in terms of, do we have something else end of this week coming on the board in terms of major events or economic data? Not that I'm aware of. So, I mean, the uncertainty seems like it's past, right? We had this, this chop here from uncertainty over the meeting, and then we've kind of been trading up here, moving in this area. As I said, heading out contextually, we're still looking at, if we look at SPX and how gamma and such is accumulated, right, we're still looking at, this is optimism, right? This is primarily call skewed. Okay, we've got, a little bit, some neutral marks here, but basically way out through February OPEX. we're call skewed, right? These are decent, call gamma expiries, right? Assuming, of course, that traders tend to be long calls, right? And the vast majority of options by retail traders, by the majority of participants in the S&P 500. 75% of all retail trade volume is on 0 DTE single leg options, meaning either long puts or long calls. Typically, they tend not to short trades. Traders tend not to, I should say, retail traders tend not to short. They tend to only be on the long side of options. And so, yeah, what we see optimism certainly heading out into mid-February. That's what this says for right now. Now, can that change? Absolutely, right? That can always change. But right now, that's not how things are structured. So what that means is we're likely looking at a kind of slow, stable, grindy up move toward our call wall, which is back at 610 again. And then to see, okay, can we maintain this upward trajectory for another test of an all-time high, right? Can we push through this and then get that test be like 614, 615 on SPY, like 615.50, 1660, something like that over on SPX. We saw a test of that once, right? Last week we saw that test and then it was rejected and sort of moved back down through here, right? Very, very quickly, probably with the deleveraging of the yen carry trade in the pre-market and overnight activity between Friday and Monday. So we're still in this area. Now that uncertainty has passed from yesterday, we're probably looking at the very least, even if we don't get a test of all-time highs, hanging out in this positive gamma area, which, okay, Michael, what does that have to do with GameStop? Well, while the broader market is trading in these more stable areas, it's more difficult for institutions, or I should say it's riskier for institutions to go ahead and try to short GameStop through supports in its own trading structure, to take short shares and do that, right? Because they don't have this background, say, of like ETF outflows and things like that. They don't have this kind of, called it a patina before, but they don't have an environment of selling. They don't have an environment of sort of moving out of equities. Things are stable. There isn't uncertainty. And so because they don't have kind of this background slight sell pressure, it's a little bit more risky for them to go ahead and just dump shares on the stock to try to move it below some of these lower thresholds. And as we'll see as we move into our options data today, that's going to be a little even trickier for them, at least heading into the end of this week. So we'll look at that in a second. Yesterday's price action, yeah, I mean, pretty boring. The only kind of interesting times we had a little bit of action early, but really, as you can see, not much, very low volume, little bit of volatility, giving us an intraday low just above 27 when the Fed was doing its thing. Right, we had an IV spike when that was going on, but not super high, couple percentage points, nothing major. The real price action actually really came right after hours once we got Ryan Cohen disclosing his 13D, and then the overnight window opened by. Right, this is about overnight window. No. This is way later. Yeah, this was overnight trading. Overnight trading ended up taking us to this sort of arbitrage zone between the resistance line of our macro bear channel right now, bearish regression channel, and the range bound sort of sub regression channel we've been in. We just hung out in there and kind of started to move back down there now. If we take a look over at our chart now, what do we see here? Basically more of the same, right? Kind of a little bit down here, a little bit down, but still kind of hanging out up there. Okay, so yeah, so what are we looking at then technically, like what's going on? Yeah, short shares kind of the same, options volume the same, neutral, not super high. Daily volume still at those kind of bottom of the volatility cycle, historic lows of daily trade volume we've been seeing. So very predictable yesterday in terms of what we would continue to expect to see at this sort of 2-week bottom of our volatility cycles. The stuff that we saw in April, August, and October, if you want a deeper breakdown into what that looks like or what that has looked like, go ahead and check out yesterday's video, specifically yesterday's video. I broke this down in deeper detail. So that's linked if you're in today's article, that's up in the current context section. Of course, you can find this on my YouTube channel. Shares available to borrow. This sort of stood out to me while I was writing this up today. We were hanging out around 2.1 million. So we didn't really get any shorting yesterday. Nothing noticeable. What did stick out to me was early today. So in the pre-market section, session, we did dip down from 2 million to 106 to 1 million, 600,000, 1 million, 700,000. Let's take a look what that looks like now. So the reason I'm concerned about this, right, is when we see historically, when we've seen these, it's back down to 1.6 million. When we see these numbers go down, like in the pre-market hours, see, that's different. If we see overnight stuff, if we see stuff at like 1 in the morning or 2 in the morning, the shares go down 400,000 and they pop back up by like 5 o'clock in the morning Eastern time, then not really to worry about, right? That's settlement stuff. That's closing trades. That's probably, settling closed short trades from the previous day, something like that. That's what I would generally surmise that to be. It doesn't really forward project anything that has to do with our price action the next day. Now, what is a bit concerning is that this type of price action where we see nothing happen in the price, but then the shares available to borrow in pre-market trading go down measurably. And I don't mean by like 100K like this. I mean like 400 or 500,000 shares. What that has generally meant is that an institution, is planning later that day to use those shares to tactically short the stock. That's generally what I've seen. I've seen that happen a few times. This is just kind of me recollecting this. I haven't made a formal study of this. Certainly, if you've watched these numbers a bit more closely, go ahead and say something in the comments. But that's generally what that's pointed out to me. So if we don't see, and it doesn't look like we're going to see this, we're still hanging out at 1.6 million shares available to borrow. So we're still down about 400, 500,000 from what we've been seeing in the overnight period. It strikes me as there's probably an institution that's going to use these in order to short the stock. Because we just got a major euphoria event, right? We got something that's causing a lot of hype in the retail investor community. That sort of signals to me, oh, okay, I'm an institution. Retail buyers are going to be a little bit over enthusiastic here. We can go ahead and, number one, we want to keep a lid on that because that's going to start to, going back to 2021, the late phases of what really drove the sneeze really was the stock going viral, was the media talking about GameStop, was everybody and their mother opening, a Robinhood account to then go and buy shares of GameStop. That's what drove that, like the peak stuff of the sneeze from like the 26th or the 25th to the 29th. That's really what was driving it at that point. If you go take a look at the SEC report on what really drove this, like the options component, like the gamma squeeze portion of this, of the sneeze in 2021, the stuff that was driven by call buying, like let's say all of the WSB call buying, the Wall Street bets call buying that sort of drove price action in December and January, that was pretty much done by January 22nd because calls got so crazy expensive at that point. There was call buying, but what the SEC found is actually that was institutions buying back calls because it was too hard for them to get a hold of shares after that point. So it really wasn't options that was driving stuff between the 22nd and the 29th. The options phase or the options frenzy phase of that was kind of over by the 22nd. What really was driving it was retail, and I mean retail. I'm not talking WSB that like kind of knows something about what's going on and they've been screwing around for a year with trading. No, I'm talking like random people who created brokerage accounts and could do so very easily because of how easy like Robinhood and Webull and stuff made it, just going and being like, oh, $400 for a GameStop share, whatever, it's free money. Like, okay, right, something like that, buying share lottery tickets or something. And so, institutions who maybe still have this kind of deep synthetic short exposure to GameStop don't want those type of events kind of ruining their carefully controlled volatility cycles. I mean, this is again still speculation on my part, but if I was in their position, I would be worried about that, because that really was a problem in 2021 for them, and that was sort of the icing on the cake that really destabilized the whole pie. Something like that. Mixed bakery metaphors. That's what we're all about here at 21st Century Renaissance. So I'm a little concerned about that, in the sense that, okay, do I think that's going to mean critical price collapse? No, and I'll point that out in a second. I think that's also has a lot to do with our 2650 puts, these short puts. But I would say that this is a signal to me that we might see, there's a strong chance we're going to see some tactical shorting throughout the day in order to keep a lid on things. Now, maybe the price doesn't go crazy, or maybe there's already an anticipation that the price is going to go up at open, and these shares are going to be used in order to suppress the price, something like that. But that's that's why I'm keeping my eye on that, right? I'm calling that out. Technicals, another thing that suggests this for me is, okay, we have had enough time now that we do have meaningful technical paradigms coming in on our 4-hour chart. So we have had our macro bearish regression channel here, which is for the meantime replaced this macro bullish channel. We do have this as a sequence here. It hasn't jeopardized kind of, if we do break back out to the upside here and we can get kind of a bigger swing in the months to come, then we'll have an even bigger macro bull channel kind of forming, right? So if we bump out, for example, let's go here. If we bump out to the weekly chart, right? Like you can kind of see, and this is sort of projected by this trend line here, there is something of a regression channel that you can see, like huge and wide, not like super useful right now to trade off of by any means. But something like that could be forming if we end up sort of, we'd have to move to like 50, right? We'd have to like kind of trade flat, kind of hang out around here and then like reverse to like 50 by, I don't know, May. And if we did that, then it would be pretty like a broader regression channel here on our weekly chart would be visible. We'd have to get something like that, right? But so certainly that's, there's still potential for that to form up. But in our 4-hour chart, we kind of have this, okay, this bull sequence, this smaller bull sequence for a couple months, right? Moved out of that. It's been transformed into this bearish regression channel. But of course, then we have this sub channel, just like this sub channel here, right? We had a bearish regression channel forming here, and then it transformed into this. First, it was range bound. It was pretty range bound. And then it transformed into a sub bullish regression. We have this this range bound kind of sub channel. Now it's pretty range bound. Forming up kind of in the middle of our bearish regression channel. It's forcing the bearish regression channel, right, to flatten out, which is good to see. But right, what we usually have when the resistance lines of these two channels intersect, there's then something of a critical question mark there, which is, okay, like, do we just move out of this now? Like, what is going to assert itself? Is it the range bound pattern, or is it the bearish pattern that's going to assert itself? And usually we get something kind of in the middle. We don't get kind of breakouts that then, I suppose we could, but we usually don't get a breakout that really challenges those archetypes in profound ways. What I would think, what I might suspect these short shares could be used to do, because we have an intersection of the resistance lines of both of these, and right, we're sitting right at this price level. It's the same basic pricing here of our 200 week moving average, which is at about 2769, 2770. So we've got a triple technical resistance there. These two regression channels that we've been working in, and what's going on with our weekly 200 moving average, which we've shown as a resistance point. I could see these shares being used to short the stock, maybe back down to like the 27 area, kind of off of the open today, as a way to preserve the status quo here. Which, if you look as we've been looking at our options data, if we look at the way that our max pain strikes kind of heading out into heading out into February OPEX are structured, it's like basically all of the max pain points are around 27, 2750, 27, 26, 27, right? They're basically all 27 all the way out through really into March OPEX right now, but that's because we don't have the earlier March weeklies available. So, okay. So we do have that coming up, which says, all right, that's a technical signal. We'd kind of curl back down. Not crazy, right? Not crazy strongly to the downside. And the reason for that is the same factor. Another sort of doubling down on this factor that I've been pointing out is that somebody is just selling puts at 2650 weeklies, just like 2 weeks ago we saw happen at 27. Now at 2650, we have another 2,000 contracts. We had another 2,000 puts sold at open yesterday. So these are trader short puts, which means they're dealer long puts, which means dealers have, counter to what is expected, what is typical of trader buying patterns, of retail buying patterns, of therefore gamma exposure data that's reported, is that dealers are negative gamma and negative delta. They are gamma negative and gamma negative and delta negative, those puts at that strike, which means as that strike is approached and as the delta values, as the negative delta values on that contract go up and as the negative gamma values go up, it means, well, up in terms of absolute value, down in terms of they negatize, right? The negative integers get larger as you move toward that strike. It means they have to correspondingly hedge that by buying shares to remain delta and gamma neutral. So that's a lot more, right? That's however many points of delta that is. Maximally, let's see. What would that be? Maximally, right, that's going to be 200,000 shares. But the delta is never going to get that high. There we go. So right now the delta is negative 0.23 and gamma is 0.17. So yeah, so right now that's accounting for, as those go up, that's a high gamma, dog. Dang. So those, right, so as that gets approached, like that delta value is going to go up real fast. If 0.17, right? And then basically as that goes in the money, it looks like that's going to peak at around 0.22. So they're going to have to hedge that value there at 0.22, and their delta value is going to go up. Where's it going to be? What's this now? Yeah, so you can look at like whatever's at the money now, and the 28s are basically at the money now. Well, they're in the money. 2750. So it'll be like around 0.5. It'll be around 0.5. The gamma is going to be around 0.22. So they'll be hedging something like 70% of the total share hedging value of that position, rough estimate. And so that's going to be, if there are 7,000 contracts there, that's something like, they'll have to, from where they are now, they'll have to buy like several 100,000 more shares. They'll be, as that strike is approached. Right, that's not what we expect. Usually they're selling as that. If that were trader long puts and they were short those puts, they would sell shares as those as that contract's gamma and delta values appreciated in terms of absolute value. But they're doing the opposite there. So intraday, that's going to be a deceptively strong support. And if you look at it on our gamma data, right, here it is. Here's this trader, whoever this trader was, right? Some at the ask. Right, not all of these were at the bid, but right? Most of these today, right? This was like a 2,000 contract order. So most of this, right? And we know from before, we know that 4,000 of those were sold short 2 days ago. Almost, right? No, not 4,000, 3,000. So we know that there's something like 5,000 out of 7,000, at least 5,000 out of 7,000 puts at this strike are trader short and dealer long. So that's definitely going to be a deceptively supportive level intraday. I even put a green box around it today because like that usually, like, you put a deep red box, you're like, oh no, but that's going to be deceptively supportive. So, okay, what does this mean? It means that if we get shorted today, that's probably, okay, could they push us through there? Yeah, right. You can spend a few 100,000 shares, like right when it gets to 2650. If an institution wanted to push us through there, and they just wanted to borrow 300,000 shares to do that, like that's probably, it would take about 300,000 shares. So, you see that approaching, and you just see, whoop, like red candles popping up, and 300,000 shares just materialize out of nowhere and pushes the price through. That could happen. But then what happens here? Once we push through here, I mean, not a lot of hedging in general down below us. Every time we've tried to push through here, just gets bought back up, right? We slightly dipped below this at the broader market sell-off on Monday, and then quickly returned back to the upside. So it seems that for now, we do have a lot of potential buyers who are waiting to do business in this range. Like they're seeing 26, 25, 50, 25, which, we haven't seen 25 since early November. But basically, right, we didn't even push below 26 during that low, that huge shorting low back in early December. So there's a lot of people willing to go ahead and buy shares or open positions or trade this bullishly whenever we show this value. So I don't necessarily know that an institution, okay, they could use a good use if you were an institution and you wanted to keep the price like a lid on the price. A good use might be to use those shares in order to push the price into that 2650 level, in the hope that most people are not going to this depth to read the gamma exposure data, do not have access to looking at these individual trades, and might be concerned that 2650 is actually a high volatility position to the downside rather than a supportive position to the upside, not knowing necessarily that there's a huge accumulation of trader short calls there. So like if I were an institution and I really wanted to keep a lid on the price, like I could see like open, maybe push us a little bit up to 28, so we get that, because that's a decent size resistance position, and then let some people kind of euphoria buy into these call positions, sell some, and then take a few 100,000 shares, and then kind of when we slam into that, when we get that kind of stutter at this big call gamma position, then allow the ramp back down to the downside to happen, and then kind of maybe take 100,000 shares or something, and like when we get to 27, kind of dump 100,000 there, push us down lower, and prepare basically at that point to then at 2650, right, nudge that down, and then at 2650, flip the switch, cover all those short positions on the lit market, and then having first close all my short calls, and then flip the switch, cover those short shares. A couple 100,000 shares of buying is going to send us back the other way, and then maybe we can get something of a gamma ramp dynamic, which we have in place, right? Maybe IV is going to flip back the other way if we buy those back pretty quickly, and then if we buy some out of the money calls right around this place, even especially short dated stuff, then we can just profit off of the ensuing up move. We'll get, especially retail options traders will probably dogpile that up move. Like, retail traders are momentum traders, right? They don't trade things that are going to happen. They trade things that are happening in the moment. So you'll have some dogpiling will happen there. And then as you kind of move up through the 28 level, then you can then you can sell whatever calls you just had in that range, right? So with that being said, that's a scenario. I'm not saying that's going to happen, but that's a scenario if I were like really concerned about wanting to keep a lid on the price today for some reason. That's something that I like. If I had the ability to do that, like that's what I would do. But even if that doesn't happen, if that's not necessary, and we can just kind of, whoops, if I do this once per recording, if we can just kind of hang out in this range, or then kind of slightly kind of calm into 27, even with a little bit of shorting, they could also wait until tomorrow to run this ramp. So to run us up in terms of gamma hedging, to exploit our low IV, to get that quick kind of IV reversal to the upside. They could do that. And what we've seen, what does that look like? Usually there's a tell, and the tell is going into the close the day before the ramp is going to run. Whatever institution is going to make this ramp run, this combo gamma Vanna ramp, is that I typically will notice some like a weird concentration of near dated out of the money calls. So retail traders typically are picking up like 1, 5, 10, like, because they're still not that cheap. It's not they're not picking up stuff for pennies. The retail traders that are trying to play pennies, get like the cheapest of the cheap, will just kind of go way up the options chain and buy like 40s or 60s or hundreds or 125s in some cases, which sometimes that can work, but like you got to get. I'm not even gonna go there. They'll buy those, hold them too long, doesn't work out because they're trying to play. Essentially, that's only an IV play at that point. And most retail traders don't actually know how to anticipate IV movements, so that doesn't usually work out. But yeah, it'll be a well-placed, I'll say this, it's a well-placed short dated out of the money contract. And it'll be like 1,000 or 2,000 of them will come in as like a couple block orders. Not a lot, right? It's not hugely conspicuous. It's not like, 120,000 like Roaring Kitty, right? It's not hugely conspicuous. But it'll be a couple, right? Something that they think they can exit easily the next day in low volume conditions, relatively elevated volume compared to what we've seen, maybe going from 3 million shares a day to like 6 or 8. But, if you're going in for 20,000 contracts, like low chance you're going to be able to exit all those the next day on an up move that's that small. You got to have a big up move to be able to exit, 20,000 or 10,000 calls. You're just not going to have enough buyers. 1,000, 1,500, you can do that. So that's kind of a tell. Late in the day, IV's low, price is going down. You see somebody come in, maybe a couple people, right, at a couple different strikes, 1,000 contracts, all long at the ask, like for 30s or maybe even 35s. Like it depends. That can be a tell that maybe somebody is gonna try to do something like that. Again, not a guarantee. This is not financial advice. This is not trade advice. I'm not telling anybody necessarily to go do this, right? Long calls, especially like that, especially out of the money, especially short dated, highly risky, structured not in your favor. The only reason that these guys can do this and get away with it because they know they're the ones that are going to cause the reversal to the upside. So that's different, right? Like if you could cause a move to the upside the next day, then that's a lot less risky. But if you're just trying to bet on somebody else who you have no knowledge of doing that, then that's a probability game, and it's not structured, never structured in your favor. So just to keep that in mind as a disclaimer. So okay, IV kind of looking the same, certainly set up in a way that they could exploit something like that. I'll be on watch to see if I see anything like that today. Maybe, yeah, we do get something in the Ryan Cohen dimension of things. Like I said, I don't know what that could necessarily, what that could mean or what, he does with that. Maybe that could be something that spoils this particular volatility cycle in a way that moves the price to the upside. Maybe it does restrict the lending pool. Maybe it does cause some kind of issue, into the next cycle. Yeah, not sure definitely on that front. But this is what I'm seeing for today. Yeah, so hey, everybody, good luck out there today. Good luck with your trades. Thank you, as always, for watching and listening. Let me know what you think, of course, down in the comments. You have questions, concerns, holes to poke, whatever I'm talking about, please go ahead and do so. Always happy to hear from you. Yeah, so thanks very much. We'll see you tomorrow, right? Tomorrow's Friday, so we'll see you before market open with tomorrow's breakdown video. And then, of course, tomorrow night, we have our live stream at 4 p.m. Eastern time, so hope to see all of you there. It'll be a good time, always a good time. So take care, everybody. Thanks so much.